The internet is full of a ton of misleading information when it comes to investing. Today, we're going to be debunking some of the myths out there and hopefully pointing people into a better direction. If you don't know already, my name is Kevin Pira. I am a certified financial planner practitioner. Let's go ahead and jump into these clips.
I'm still in disbelief that I won $7,000 from the Chiefs winning the Super Bowl. I don't know what to do with all that money. I might just throw it into penny stocks. What do you guys think? All right, if you're new here, I spin the wheel, and whatever penny stock it lands on, that's how much money I throw at it. Let's find out. TGL, okay. And now for a fun edition, let's see how much I throw into TGL. It could be anywhere from $100 to $300. Let's see. 175. Nice. Stats. Do your research, everybody. Not me, but you should do your research for sure. And done. $177 at 9 cents a share for a total of 1,935 shares.
Okay, so this guy literally is spinning a wheel to determine which stocks he's going to purchase, and then also spinning another wheel to determine how much he's going to purchase of some random penny stocks out there. You know, he said he got $7,000 from, I guess, maybe sports gambling or something on the Chiefs. And it's just sad because if this dude just took that money, you know, contributed regularly just to like a low-cost index fund or something like that, he probably is going to be a multi-millionaire later in life. But instead, he's chasing this high of investing in penny stocks. But if that's what he wants to do, that's what he wants to do. But I don't think I need to explain to you guys why that is a very stupid thing to do.
Why is stocks just like professional gambling that's accepted? Because I'm so sorry, it's not gonna lie, a gamble. All the time, you know? And maybe that's just because, you know, I invested in some stocks. I'm just a little confused because I thought stocks was like, you only grow your money. I have like the same exact amount of money. Maybe even less sometimes by like $1 or $2. But I'm just a little confused because I'm like, if I'm able to lose money off this, why is this not like gambling? No one ever says stocks is like gambling, but it low-key is exactly like gambling, but it's just like, what? More professionally accepted? Like, I'm sorry, please explain the difference between stocks and gambling to me.
That is a great question. So what is the difference between investing in the stock market and then just gambling at a casino? So when you buy a stock in a company, you're actually owning a piece of that company, and you're hoping that company over time is going to increase in value from increased profits, and it grows, and then that's going to increase the value of your stock. Gambling is basically making a bet or a wager against a casino that already has an edge against you. You are definitely not going to make money over time in a casino because it's literally betting against yourself. Whereas with a stock, you know, you're investing in a company, it grows over time, and we know that stocks have a very good return in the long run. So that would be the main difference. The problem is that we have people like the previous gentleman in the previous video who is literally spinning wheels to determine which stocks he wants to invest in. That is a lot more akin to gambling than just say investing in the stock market in like a low-cost, broad market index fund, which is a great way to invest. So good question, and hopefully that helped answer that.
What's a scam that's become so normalized that we don't even realize it's a scam anymore?
A Roth IRA. Now hear me out on this one. All of the benefits of a Roth IRA are just mimicking a vehicle that's been around for over 100 years, and that is cash value life insurance. Now, while the middle class is super excited to save $6,000 a year and have that accrue tax-free, the wealthy are doing something very similar, except they have no limitation. I say that because with these tax codes, the wealthy are able to put in as much money as they want into this account, not limited to just $6,000 a year. It's still all accruing interest tax-free, except they also get to access that money at any age, tax-free and penalty-free. And when they pass away, the money will double or triple and get passed down to their heirs completely tax-free.
Okay, so this one is really bad because there is just a ton of misinformation going on here. So the Roth IRA, one of the cleanest, simplest, retirement accounts out there. You put money in there after tax, grows tax-free, tax-free withdrawals. Awesome, simple, love it. A whole life insurance policy is a life insurance policy with a savings component built into it. Now, to correct some of the misinformation here, because he was wrong about just about everything, you can't just throw as much money as you want to into a whole life policy. If you do that, it's going to turn into a MEC, which is a modified endowment contract. When you do that, the taxation gets completely flipped on its head, and it gets completely screwed when it comes to taxes. Secondly, he is completely blurring the line between tax-free and tax-deferred growth. So I won't get too much into it, but with a whole life policy, you put money into it, it can grow based off a certain calculation. That money gets tax-deferred. Tax-free for that type of policy comes from the death benefit. So if you were to pass away, that money gets passed to the heirs tax-free. Guess what? A term life insurance policy for like a 20th of the cost and way more coverage also has a tax-free death benefit usually as well. The big problem with these whole life insurance products is that the people trying to sell you them get a high commission for a product that is pretty much complete crap. And that is the facts.
The stock market is probably a scam. It's just a piggy bank for the people who own most of the shares, and then they dilute the crap out of you with stock-based comp. That was sort of like the lesson of Tesla. It's like, okay, cool, Elon's rich, now he's gonna sell $25 billion of Tesla. The stock goes down for 2.5 years because it becomes the easiest short trade. Insiders are selling and dumping on the retail investor that's believing in this vision. But you're not inside the company realizing that sales are hitting a wall, margins are about to hit a wall, and you're not benefiting from the inside information that they are and trading against you with.
All right, so most of what he's saying is not incorrect, but his conclusion is definitely a bit too emotional and a bit crazy. So he is correct in saying that in single stocks, there is a chance that the shares get diluted, which can push existing ownership out of the way because more shares dilute those owners. That's totally possible and happens pretty frequently. But to say the stock market is then a scam just because you can name some stocks where that's happened, or you can name some instances where there's some insider trading. Again, is the stock market perfect? Absolutely not. But it's pretty well regulated, and there are rules around insider trading to help prevent those type of things. However, saying that the entire stock market is a scam because of that is absolutely, that's asinine. And the bigger, lesson here is you don't need to be owning individual stock shares if you cannot handle that type of risk, whether emotionally or your portfolio can't handle that type of risk. And for most people, they should not be making big bets on, SpaceX and Tesla and things like that. They should be investing in low cost, broadly diversified indexes because it's going to own a lot of companies, going to have a lot of the good growth in there, and they don't need to worry about these type of issues. So something to consider. But not totally wrong, just maybe his conclusion was a bit, dramatic.
I'm about to quit my job. I've been in corporate for 10 years, at the same company for 8 years, and I'm going to quit my job and be a full-time day trader and keep my kids home from daycare and enjoy the summer with them. And I have been working for this for a long time, so I'm going to quit my job. I'm so nervous. I quit.
Okay, so that's awesome that she is going to be spending time with her kids, but the part that is a little concerning is that she's going to be a full-time day trader. And we know that with day trading, it's literally almost 0% of people make money from day trading in the long run, especially when you consider taxes, fees, and just your own time commitment. So what I would say is anybody on TikTok who mentions day trading and that they're quitting their job to day trade, check their profile because they're probably trying to sell you a course, and that's probably where most of their money is coming from. So be very skeptical about these types of claims and don't waste your time with day trading.
How much passive income can you make each week on $1,200? Let me show you. So how to make passive income with $1,200 selling covered calls. So essentially what you want to do is you have to pick a stock that is cumulatively less than $1,200 after buying 100 shares. So you can see, quick math tells me I can buy 100 shares of this stock for $11.84 a share, $1,184. All right, so let's assume I have 100 shares. Go to trade options. I pick my date, October 21st. I'm on sell and call. I can pick this $12 contract, which essentially means I'm agreeing to sell a stock for $12 at the end of the week, and I'm going to get $46 immediately for agreeing to do that. Now, two things can happen. The stock finishes above $12. It doesn't matter what price. I have to sell the stock for $12 a share. If it stays below $12 like it is now, I get to keep my shares, and I can repeat the same process next week. The best part is, in either scenario, I keep the $46 that was paid to me for putting my shares up as collateral in this contract. I repeat this on numerous occasions each week to do over $1,000 in premium each week.
Okay, so this one is extremely misleading, and of course the dude is selling something on the back end here like a course, but let's forget that for a second and talk about the mechanics of what he's doing. So this passive income strategy hack is selling covered calls on a stock that you own, and then that's free money. It's free money that you're getting for the premiums for selling those calls. The problem is not only is there two options, there's a third option that can happen, which is the stock goes down. So let's say the stock goes from $11 to $9 or $8. Your 100 shares just went down a ton in value, and that small premium you collected is nowhere near the amount in capital loss that you just took from that stock going down. And again, it's probably not the greatest stock out there if it's priced this cheaply as well. Now, secondly, the other issue here is you're capping the upside. So let's say the stock does good and it goes from $11 to $15 or $16. You agreed to sell at $12 in this case. So you're capping your upside, keeping most of the downside for a relatively small amount of premium. That's why these strategies don't work out in the long term, and that's why they equate it to picking pennies in front of a locomotive. It might work for a little while, and you might collect, a dime, a nickel, a quarter, maybe even $1. But eventually you get hit, and the whole thing was a waste of time and money.
Stop dabbling. It's better to save. Keep that dabbling in gold. Keep that dabbling in silver where you're not exposed to inflation and where we already know silver and gold outperform the dollar year over year over year. They hedge inflation while the dollar crumbles and you continue getting paid in it. You choose to convert what you're saving into gold and silver that outperform the dollar, okay? So dabble there. Put your dabble money over here instead of around in stocks and ETFs and mutual funds and chipping away, making no impact for several years. Be disciplined and keep it in gold and silver.
Okay, so this one is a very silly comparison. So we're comparing silver and gold versus the US dollar. Anybody who's holding the US dollar just cash for 30, 40, 50 years does not know what they're doing with their investments and needs to go invest in something else. When you compare gold and silver to an actual productive asset, like say stocks or mutual funds, then the answer is a lot more clear that those have dominated in the long term. Now, I don't hate gold or silver, and I think it can be a fun, small diversifier in a portfolio, but it's not the same thing as a US dollar, which is a currency to go purchase things. You can use it to maybe hedge inflation or use it as a store of value, but at the end of the day, it's a piece of metal that's not going to be doing anything productive. So again, a small diversifier as a fun little thing, but outside of that, there's really no reason to own any of it.
So I've got diversify, I've got reduce your position. There is probably going to be a bit of a job disruption as well.
And particularly if you have to own stocks, own them outside America. Don't own US stocks. That's a nice, simple strategy that you can act on.
Why?
They're much cheaper. And since the beginning of last year, they have handsomely outperformed the US.
You're not confident in which part? That the US
I'm not confident that US equities will be intact in 5 years, 10 years.
So a US equity is a US stock?
Yes.
Why aren't you confident that they'll be intact in 5 or 10 years?
Because they're so badly overpriced today.
Okay, so this one's pretty interesting because he's not entirely wrong, but again, his conclusion just seems so dramatic. So he's basically saying that you shouldn't own any US stocks going forward because valuations are high and international equities are cheap. So the truth of kernel there is that yes, US stocks are overvalued by historical standards, and it is true that we do expect a slightly lower return going forward compared to historical US returns. That does not mean you should not invest in US equities. In fact, I still think investing in US equities is probably going to be the core, if not the main makeup of most portfolios out there. And then maybe you have more international compared to historical standards. Now, going forward, even though we do think the US stock market may not perform as good as it has, that doesn't necessarily mean that is for sure. Valuations can remain higher a lot longer than people think. And not to mention, when he's saying that international equities have outperformed the US recently, that's true, and that was mostly like last year. the further out you look, US equities have dominated international equities by a large margin. So again, we have to be careful about, maybe cherry picking some of the data or trying to basically time the market. That's where things get me a little nervous and I get worried. So definitely some good, truths in there. But again, I think the conclusion is just way too strong and probably a pretty bad investing strategy for most people. All right, you guys, there you have it. Hopefully you did enjoy watching some of those clips and reacting alongside with me. And if you are new around here, please consider subscribing, and any likes or comments are greatly appreciated as well. That's all that I have, so have a great day, and I'll catch you in the next one.